your dependent adult children are going to pay tax on the death benefits paid from the taxable component. And that's where we talk about estate taxes. Now, there are no estate taxes, but we do have death benefits tax. Hi, you're listening to the Unlock Your Business podcast, where we discuss ways you can unlock your personal and business wealth with financial, investment, and business strategies. I'm Rafi Pelagian. I'm a financial advisor and run financial services businesses that aim to help individuals, families, and small to medium business executives manage, grow, and protect their wealth. Through this podcast, I share my experience and knowledge from a financial advisor and business owner's perspective, in addition to my wins and struggles. So if you want an authentic and honest discussion on personal and business growth, investment, management, and unlocking wealth creation strategies, you've come to the right place. The Unlock Your Business podcast is brought to you by financial advice firm Manly Financial Services. Please see the website links in the show notes. We hope you enjoy the discussion. Hey, we're back. Welcome to the Unlock Your Business podcast. It's been a while since I've had a podcast episode, but we've made some changes in the way we're doing things in relation to podcasts, YouTube videos, and all that kind of thing between the businesses that I run. And we thought that we'll start with a podcast episode. So I do enjoy doing these podcast episodes, but as I said, haven't done one for quite a while, as we've been quite busy restructuring other parts of our business. So let's quickly talk about the progression of this podcast, the Unlock Your Business podcast. Well, initially I focused on the SME owners and executives market with really a business strategy focus. Even though I do personal financial planning, I'm quite interested in how the business runs, the strategy we take on board, and business growth. So the podcast was really an opportunity for me to talk about those things that I'm quite interested in and have a discussion and maybe learn a few things along the way. Definitely learn a few things along the way. But I found that obviously looking at the number of episodes I've been able to record based on time, it was really hard to get some content that I felt was going to be beneficial to people, or even though obviously day to day as a small business owner a lot happens, positive and negative. So what we decided to do is to include some financial planning content to provide more content that individuals, families, personal investors, as well as small and medium business owners and executives can benefit from. One of the focus areas for our business, particularly from my perspective, is to provide personal wealth advice to business owners, personal wealth advice and business advisory advice and consulting to SME owners and executives. And obviously, from a day-to-day perspective, I deal with a lot of personal clients, non-business owner clients, pre-retirement, post-retirement, that kind of thing. So it's a really good way to extend some of this content that can benefit people from both sort of areas or realms, if you like. So here we go. And the other thing is, from a content perspective, we won't just be posting these podcasts on the normal areas where, like Spotify and iTunes, where you can get podcast episodes, but we'll also be recording them as I'm doing now and editing them up and putting them on YouTube. So our videos that are coming out for the podcast and also brought to you by Manly Financial Services, those particular videos will be longer format style videos like this one, a little bit potentially more technical, more of a podcast style discussion, whereas we've still got our normal vlogs that we're doing, hopefully more on a more regular basis, that are more bite-sized and digestible, if that makes sense. So at the end of the day, hopefully we can create a whole person type perspective around these discussions from a financial planning and a business owner executive perspective, and hopefully give some good beneficial content to all sorts of people out there. So let's talk about death taxes. So we all know or believe that there's no estate taxes in Australia. Well, there sort of are. And a lot of the work we've been doing on the superannuation side with our clients who are not so much approaching, but just transitioning into that retirement, really at that point, is around trying to reduce the estate tax, I'll put in inverted commas, burden for their kids, which is really important. Because if we just rejig a few things, then we can get a really good outcome for beneficiaries of super funds, particularly beneficiaries that are over age 18 children. Okay, so that's really what we want to talk about today. So a few things you wouldn't know, some technical areas that people really don't talk about, and ways that we found that we can save beneficiaries, tens of thousands, hundreds of thousands of dollars in taxation at when funds are transferred from mum, dad, as a super fund member, pension member at that time, to the children. So let's quickly talk about super and do a bit of a recap. How does it work and what are the benefits, both in accumulation as we're adding to it and in pension phase? So as we all know, superannuation is an investment and tax environment. It's not an investment in itself. So when people come to me and they might not know a lot about super, and they might say, well, Rafi, super, I don't think super is a good investment. Well, super is not an investment. Super is an environment, a tax environment, an entity in itself. Just like a company is an entity, a trust is an entity. It's just a tax environment. Within that tax environment, we can invest in all sorts of things. The key is in superannuation that the investments are for the sole purpose for retirement. We've got this sole purpose test, and one of the ways we can breach that test is if we bought a property in our super, which is something we can do, and we'll be doing some podcasts around that because we're doing a lot of work on that sort of area on an ongoing basis. But if we were to buy a property in the fund, but then go and live in it, well, clearly the asset was not purchased for the sole purpose of retirement, therefore it fails the sole purpose test. It has to be a property, in that particular example, that is being leased out, and someone else will pay the lease. It's someone external, and they will pay the rent, and the rent goes back into the super fund for the sole purpose of accumulating that fund for the retirement of the members. Now, superannuation, we can invest in an employer-sponsored fund. We can invest in an industry fund, those, whatever that stupid thing is. We can invest in retail and wholesale platforms. We can invest in self-managed super funds, really depending on what the member's trying to achieve. If cost is the most important thing, then maybe we would look at an industry fund or a retail fund. You've got to watch some of those industry funds because they're not exactly true to label when it comes to costs. Might be low in admin fees, but not really anywhere else. On the other hand, if we want to buy a property, then we've got to start looking at something where we've got a lot more control and flexibility around the available assets, and a self-managed super fund would be more appropriate. So from our perspective, we look across the board. And then the underlying funds in our super, we can invest in shares, we can invest in property, we can invest in fixed interest, cash. We can invest more or less in anything that's allowable under the trust deed of the fund and acceptable under the Super Industry Supervision Act that we've got to abide by, with the aim of growing our funds in super. Okay? Now, how can we get money into the fund? So we talked about how super funds look and work and are structured. Well, there's effectively a number of ways to get money into the fund. Now, we can contribute pre-tax, which is a contribution similar to what our employer would make on our behalf, that super guarantee contribution. And we can make pre-tax contributions ourselves. So these are contributions that come from gross salary. Or we can make post-tax contributions. And by post-tax, I mean if we've got some savings outside of super and we want to put that into the super fund, we can contribute those funds as well. So our pre-tax contributions are called concessional contributions. As I said, they include our employer contribution, any personal contribution that we want to claim a tax deduction on, and we do have caps here. So the most we can claim as a tax deduction this current financial year is $27,500 per annum. That's including what our employer will put in on our behalf. And then and next year that'll be $30,000. So it's being increased next financial year. And the personal contributions from post-tax money, say I sell some shares, I sell a property, I've got some money from an inheritance, I've got some cash that I've saved, I want to put that money into super, don't want to claim a tax deduction. That's what we call a non-concessional contribution. And those funds, again, have a limit. Now, that limit at the moment, this financial year is 110,000. It increases to 120 next year. And there are ways that we can maximize that by putting 3 years in at once on all sorts of things. Now, key thing to note is that a concessional contribution, the one that we're claiming a tax deduction on, does get taxed at 15% in the fund. Okay? So the benefit here is that if I'm paying 30+% in tax personally on my salary, and I've got room in that $27,500 cap, I can make a contribution to super. I won't pay that 30% tax or 40% tax on my salary as an income tax, but I will pay 15% as it's contributed to the fund. So technically, I'm 15+% better off in that particular scenario. So that's an important point to note. Non-concessional contributions, on the other hand, are completely tax-free. Okay, when we make that contribution, and tax-free as we take those funds out when we retire. So they're the main types of contributions. There are some others, and I guess the most topical one these days are these downsizer contributions. Now, downsizer contributions are non-concessional contributions in nature. There's no tax that we pay. The limit's a bit different in that we've got $300,000 each that we can contribute once we get over a particular age and we downsize the house. Okay, and these contributions are in excess of the non-concessional cap. And we'll be doing a podcast or a video soon talking about a particular situation where we've been able to maximize a contribution strategy for a client that's recently come to us and said, hey, we've just sold the house. We've got over $1 million to put into super after buying the retirement home, if you like. And how do we maximize that in terms of from a contribution perspective so that we can start to retire and enjoy our retirement? And we'll talk about that. So we've talked about what funds look like. We've talked about how to get money into the fund. What you'll notice is that we talked about limits on getting money into a super fund. Now, a long time ago, we would be taxed higher when we accessed money from the fund, and we had much looser limits. But I think it was around about 2007 when we had the simpler super reforms that didn't really make things simpler, but they just changed the focus. The focus then changed to having more limits up front and make it easier to get money out of super. So a bit harder to get it in, a bit easier to get it out. Now, why would the government do that when we are hoping to promote self-funding retirement? Because obviously the social security system is not going to be strong enough to be able to provide retirement benefits for all people. The main thing is that the superannuation costs the government a lot of tax revenue. So think about it. When I'm got my money in super, I'm being taxed maximum 15% on those earnings. When I'm in pension phase and I'm retired, I'm paying 0% on those earnings. Whereas if I had the money outside of super, I'd be paying somewhere around 20, 30, 40% on those earnings. So there's a lot of tax revenue that the government misses out on. And for that reason, they limit the amount we can put into super and hold in that 0 and 15% tax environment as well. Now, what are the benefits of super? So benefits are really forced savings. Your employers, at a minimum, your employer's just making the super guarantee contributions, and you've got 11% of your salary going into the super system, forced savings for retirement. At retirement, if you've got a small super fund, you start seeing some people take money out, paying off their mortgages, whatever it may be. Now we're starting to see a lot more downsizer sort of activity as people are cashing in on the property value growth of their homes. They don't need a 2-story house with 6 bedrooms for a couple that's going to retire. And also they've got a couple of $1 million or whatever it is trapped in that home that they can use to buy a retirement home at a lower value, a bit smaller, more appropriate for their retirement, and also fund their retirement lifestyle. Second benefit is we also all become investors. It's good for the economy. What are we doing when we're investing in super or having those contributions go in? Well, we're buying shares and other assets. The companies like BHP, Commonwealth Bank, whoever it is that we're investing in, whether it's through a managed fund or a investment option or direct equities in our shares within our super, those companies are using that capital to reinvest and build their businesses. They're raising capital through the market. they're hiring people. They've got no new projects. It's money flow to different sectors. It's good for the economy. We talked about tax in super, and let's talk about this a little bit more, because this is one of the main reasons or main benefits of superannuation. The maximum tax on our investment income, our dividends, our rent, our earnings, depending on our fund type, but maximum earnings is 15%, and capital gains is 15% on the gain, or 15% on 2/3 of the gain, which is effectively 10% if we're holding the asset for over 12 months. So let me say that again. Maximum tax we're paying on investment earnings, interest, dividends, rent, whatever, is 15%. And if I sell an asset, say after I've held it for 12 months, I'm only paying effectively 10% capital gains tax. Now compare that to the tax that you would be paying on from your personal income, your marginal tax rate. That could be 30, 40% on earnings. That could be 30, 40% on a capital gain, and then obviously half of that on an asset that I've held for 12 months. So there's a huge tax differential and a tax benefit in investing in super. Now, when I'm in pension phase, in drawdown phase, in retirement, I'm paying 0% tax on earnings and capital gains. That's an amazing strategy. And you've got some limits on how much you can put into super, because the first question will be, well, Rafi, why don't we just maximize the super fund? Well, there are limits to how much we can have in that zero tax environment. And then once we're over 60 and we're getting that retirement income paid to us like a pay packet, every dollar of that retirement income is tax-free as well. So this is, a legal tax environment, zero tax environment that we can use. A lot of the times I talk to my clients and try to get them to understand that pensions, when we're retiring, our super funds, when we retire and get into pension phase, is basically like a tax-free ATM. We can get money out at any time. There's no limits as to how much we can get out. There is a limit as to the minimum. We've got to get a minimum amount out of super, but there's no maximum, 100%, I guess. And effectively, we're not paying any tax on any of that in pension phase. Now, let's get a little bit more technical. So under our super fund, even though it's completely tax-free at retirement, and we're all great in that perspective, within our super fund, we've got components. Okay, there's a taxable component and a tax-free component. So, as I said, even though pensions are tax-free for pension account holders, they're not necessarily tax-free for their dependents based on these components. Okay, any concessional contribution or contribution from your employer goes to the taxable component bucket, and any non-concessional or tax or post-tax contribution that we make into the fund goes into the tax-free component bucket. Okay, so as I said, if most of your fund is added to by your employer contribution or any salary sacrifice you're making, then your super fund will have 100% taxable component. When we retire, if we put a lot of money in personally, then that's all going to add to our tax-free component bucket. Now, your dependent adult children are going to pay tax on the death benefits paid from the taxable component. And that's where we talk about estate taxes. Now, there are no estate taxes, but we do have death benefits tax. And when we look at most clients in retirement, where majority of their assets are within this beautiful super tax, super/pension concessional tax environment, and in their family home, they're really where most of the wealth is. A large part of that wealth could have a quasi-estate tax in terms of these death benefits tax if we're not careful on how we structure things. Now, how do we draw on our super at retirement? So we're going to come back to that death benefits tax, because that's really what this is all about. So once we reach preservation age, which is between 55 and 60, depending on when we're born, or we retire, or turn age 65, we can access our super. Okay, so we can't reach preservation age. If we don't reach preservation age and retire, or reach age 65, we can't access our benefits. So really got to reach preservation age and retire, or turn 65, irrespective of retirement. We can access our super either via a lump sum or via an income stream or a pension. And in that income stream pension, we can receive a regular payment without paying any tax once we're over 60, as we've already said. And we live happily ever after. Now in retirement, our super or pension is still continues to bubble along, still invested in portfolios and underlying assets. We need underlying assets. We need those assets to grow above the cost of inflation, something quite topical at this point, because if the buying power of everything or the cost of everything is going up by inflation at 3 or 4%, and our super fund is only performing at 2%, then clearly the buying power of our wealth is eroding. So we need to invest even in pension phase, and we'll have another video in the future around how we asset allocate at that time, because of course if you have a GFC come by, that would not be fun once you're in pension phase. But there's ways in which to asset allocate to make sure that your income is funded and we can ride out the volatility in markets. And as I said, we receive enough income to meet our retirement expenditure, holidays, family support, whatever it is, and we go from there. Okay, so death benefits tax. Let's talk about this. Now, I'm in retirement. We talked about what happens in retirement. Now, what if I was to pass? I was to die. Now, if I'm in retirement and I die, if the money's going to a spouse, a dependent spouse, then effectively the funds will be tax-free upon that transfer. Now, if I'm receiving a pension and my spouse is a beneficiary, say a reversionary beneficiary, that pension income will just revert to my spouse. Nice and easy, very simple. Okay. If my spouse is a binding nomination or a nomination, but they're not a reversionary nomination, then they can get those funds as a lump sum, tax-free if it goes to my spouse. But if my spouse has passed as well, and the super's just in my name, or I've passed and my spouse has all the super in her name, then the tax components are critical, because who's the money going to go to? Through the estate or through the super fund, which has its own will, if you like, it's going to go to my adult children. Now, if all of my money's in the taxable component, they're going to pay 17% tax on all the money that they receive at that time. Okay? So, on a fund that has a $500,000 taxable component, $500,000 taxable component, which is, we see that all the time, then this could be up to an $85,000 tax that they would have to pay. So instead of receiving the $500,000, they would receive, $415,000. So that's a fair whack that they would miss out on. But the good news is there's solutions as to how we can manage this. So there's a couple of steps, if you like. The first step is we can apportion our components. Okay, what does that mean? So the components that are taxable and tax-free, we have to be smart about how we manage those components. So I've recently had a client that we're working with that had all of their employer-sponsored super in a fund. They've sold the house. They're going to make all these contributions from the benefits of the house. Now, if we make those contributions to the fund that has the employer-sponsored contribution, we're effectively going to mix up those components. And by mixing the components, we won't have the benefit of the tax-free, 100% tax-free nature of these contributions that they're going to make, after they've sold the house. So by apportioning our super funds, having the client have two super funds, we're able to basically segregate those components. And that's really important. We don't want to mix benefits. We want to compartmentalize them or segregate them, as I said, to a tax-free and a taxable. Don't mix them up. Worst thing we can do. So we might need to have two super funds for a while. Now, those super funds can be identical funds. They can have the same asset allocation, same mix, same whatever it may be. A lot of funds out there do family grouping, which allows us to basically have pricing across multiple funds as if they're just the one fund, which gives us some pricing benefits. But at the end of the day, we've got to keep two funds with two separate account numbers to be able to segregate any funds that are 100% taxable component from any funds that are 100% tax-free component. Now, step 2 is our withdrawal and recontribution. Basically allowing us to, if you like, recycle the taxable into tax-free. So how do we do this? Now, based on any available non-concessional contribution limits, so you remember how I said we've got $110,000 we can put into super every year, or 330 if we do it over a 3-year period under our non-concessional limits. Well, based on that, if we've already retired, we can take funds out of our taxable component super as a lump sum and make contributions back into our tax-free component super. Okay, so moving money from the taxable component into the tax-free. Now, how much can we do? Well, we can make a contribution up to our limits. So, if a client's used up all their limit in the initial phase, let's say they've used up their limit for this year because they sold their house and they're putting some money into super, then we wait till next financial year, and then we've got that limit available to us again. So what that allows us to do next financial year is to make the withdrawal of the amount we can put back in. So let's say we can put 110 back in, make a $110,000 withdrawal from the 100% taxable component super, put that 110 tax-free into the 100% tax-free component super. And effectively over a period of time, we can move these funds from 100% taxable component to 100% tax-free component. Okay? Now, what if we're drawing a pension at the time? Well, it's simple. If we're drawing a pension from our 100% taxable component super and our 100% tax-free component super, all we need to do when we're able to make that contribution is roll it back to accumulation, roll it back to super, withdraw, contribute, roll it back to pension. Okay? It's smart financial planning aimed to reduce leakages, aimed to reduce leakage in the form of taxation back to your kids. Now, what are the benefits? Well, you can clearly see that we can save thousands of dollars, tens of thousands of dollars, just by using this simple, smart strategy. Okay, so really important. Now, these tens of thousands of dollars will make more of a difference, more of an impact to your super or your nest egg than investing in the right asset class or the right stock or the right property or the right this or the right that. I mean, this can have a huge effect on the preservation of your wealth, post-generational preservation of your wealth versus the right fund or the right asset class. So sometimes it's really important for us to prioritize what we're looking at in terms of from a super fund. Prioritize our goals. Sometimes picking the right asset class, the best asset class, isn't the be all and end all. And I don't have a crystal ball, so who's to say we've got the right asset class anyway? Okay, let's look at an example. Let's look at a bit of an example, real life example. Obviously, not mentioning any client names, but there's a client that we've worked on, working on at the moment, but really put a lot of this planning and implementation in place over the last couple of months. So the clients are retiring. They downsized the family home. They've got a net amount to invest of about $1.2 million. Plus, they've got a super fund account of about $600,000, employer-sponsored super. That's a 100% taxable component. Okay. I'll try on YouTube to put some images on to some buckets to make this work, maybe a PowerPoint type of thing. Okay, so we've made the following contributions this financial year. We've made a downsizer contribution each, $300,000 each for husband and wife. That's $600,000, and we've made the $110,000 each as a non-concessional contribution, $220,000 in total, again each. Okay, so we've reused up our limit this financial year, up until the 30th of June, which is coming up. So we've got $380,000 left in cash to contribute next financial year, which is about $190 each. Okay, $190 each against their $330,000 non-concessional bring forward cap. Okay, so they can contribute from next financial year $330,000 as a one-off contribution over the next 3 years, right? And we've got $190 each of cash that we're going to put in, all right? So you can see that there is room. There's about $140,000 each of cap space, cap room, after we make that $190,000 contribution each next financial year, okay? How do we use up this cap space? So it's $140,000. Well, after making these contributions, next financial year, We'll go to the 100% taxable component fund, which has $600,000 in it, and we will withdraw 140 each, 280,000. We'll withdraw 280,000 and then split that between the two tax-free super funds, okay? 140 in each one. So what we've done is we've effectively recycled $280,000, say almost a half of the 100% taxable component fund. We've recycled that into a tax-free, okay, which is going to be fantastic for the next generation. Now, we're doing these separate super funds because we've got to make sure we segregate the assets, like I said in step one. And we're effectively, as I said, taking funds out of the 100% taxable. It's not costing us anything to do so, any tax or anything like that. And then we are making that contribution into the two tax-free funds for husband and wife under their allowable cap, which is fantastic. Now, we can't make another contribution to super from after-tax money for 3 years, okay? Because we've used up that $330,000 cap for the next 3 years from next July, which, as I said, is going to be going up a little bit. But let's just go off the current numbers. Okay. Let's have a look at this. So what we'll do then is we will convert the three super funds, the 100% taxable one and the two tax-free ones, we'll convert them all to pension phase, okay? And then they will draw a pension for the next 3 years as they enjoy their retirement. Now, in 3 years' time, when that cap space is back, we've got more room, we're going to roll all three funds back from pension back into accumulation. Okay, back from pension, back into accumulation. Now, we can't take money out of pension accounts, or we can't add money back into pension accounts, so we've got to roll them back into accumulation. And then at that point, we're able to take out the remaining funds within the 100% taxable fund, take it all out, and make that contribution, split it evenly or however we want, into the two 100% tax-free funds at that point. So then they get to a position where 100% of their funds, okay, over a 3, 4, 5 year period, 100% of their retirement wealth is in this tax-free component. And this is important because they've got adult kids, okay? And if they've got adult kids, those adult kids would be paying tax at 17%. If we, on the 600K, depending on what the value of the 600K at the point where they passed, but they'd be paying 17% on a large proportion of funds, if we hadn't done anything. Okay, so this is just some really careful planning, going above and beyond. We don't want to just start pensions, get money in there, and tick the limits and this, that, and the other, and draw pensions and happily ever after. We want to go one extra step to make sure that from the next generation we're taken care of as well, because it's a relatively simple thing to do at the time. You just got to have some smart timing and strategizing around how to do it. Now, we've done some calcs that show that adult children could save up to $102,000 in death benefits tax. Now, obviously that would be the saving if they had passed in the short term. Touch wood, we don't want that. We love to see our clients living and enjoying their retirement. They over time become really good friends, and there's nothing that makes us happier. But effectively, if something were to happen, we're ensuring that the next generation gets a huge tax saving, again, just by employing some smart strategy, doing some ongoing financial planning as opposed to just working today. We want to work over the next few years effectively to get them going, get them implemented the right way. And then obviously, as a financial planner, a lot of our role is ongoing monitoring, ongoing review, and trying to roll with the punches that the investment markets give us, or the geopolitical issues around the world give us. And we've got a number of those to deal with right now and in 2024. So I hope you enjoyed that. Quite a longer one for me, quite a much more technical video as well. As I said, the podcasts will have a lot of this personal financial planning content out there, as well as business strategy tips and experiences and things that I'm learning all the time in terms of the day-to-day. I mean, there's a lot of that, as all small business owners would attest to. But I guess some of these strategies, obviously, they apply to anyone. Doesn't matter if they've worked for a firm all their lives, or a company all their lives, or they're running their own businesses and looking to recycle that wealth, preserve that wealth, invest that wealth for their personal enjoyment and retirement in the long run. So again, hope you enjoyed it. More content to come on YouTube. Please tick that notification bell so you're notified of content. Judging by how quickly I put content out, trust me, there are not going to be a lot of bells ringing every week. Hopefully we get something good out every month. That's really our aim. And please leave a comment if you like this. If you like the comment, please thumbs up if you can, and subscribe. That would be fantastic. And if you're getting the non-YouTube version of this podcast, please like, comment, follow wherever you digest your podcast content. We'd really appreciate that as well. Lastly, just a quick plug for Manly Financial Services, which is the firm that I manage. We're a firm with several financial planners. We have focus all the way from clients that are just starting and building their wealth, borrowing money, buying a house, investing, buying investment properties, buying shares, superannuation, insurance, all that, all the way through to people that are looking to retire, managing their retirement, looking to buy property within self-managed super funds, business owners selling their assets, and also we work in the business advisory space as well. So if we can help in any way, please visit our website, manlyfs.com.au. You can see our contact details there, email and whatnot. And I hope this has been a benefit. And if you would like some more help, please reach out and we'll be more than happy to help. Take care, and we'll see you in the next one.